Have you ever wondered how some businesses seem to effortlessly secure the funding they need to grow, while others struggle to keep their doors open, despite having great ideas and a strong work ethic? It's a question that plagues countless entrepreneurs, especially those just starting out or looking to scale up. You've probably heard about different loan options, traditional bank loans, lines of credit, even crowdfunding. But what about Square loans? However, just because it's offered doesn't mean it's guaranteed, and it certainly doesn't mean it's for everyone. There's a common misconception that simply using Square automatically qualifies you for a loan. While your transactional history with Square is indeed a crucial factor, it's far from the only one. Many business owners, excited by the prospect of easy funding, get disheartened when they don't see an offer or when an offer doesn't meet their needs. This leads to a lot of frustration and, unfortunately, missed opportunities. So, how do you bridge that gap? How do you move from simply using Square to actively positioning your business for a Square loan offer? What are the unwritten rules, the key performance indicators, and the best practices that can significantly increase your chances of eligibility? This isn't just about ticking boxes. It's about understanding the underlying logic of Square's lending model, which is built on data, consistency, and responsible business practices. In this video, we're going to dive deep into the world of Square loans, demystifying the eligibility criteria and providing you with actionable strategies to improve your chances of securing the funding you need. We'll explore everything from your sales volume and transaction history to your repayment behavior and customer disputes. We'll even touch upon the less obvious factors that Square might consider, helping you paint a complete picture of what it takes to become a prime candidate for their loan program. Whether you're just starting out with Square or you've been a loyal user for years, this guide will equip you with the knowledge to make informed decisions and ultimately to unlock the financial resources that can fuel your business's growth. Let's start with the absolute bedrock of Square loan eligibility, your sales volume and transaction history. This is where Square's proprietary data truly shines. Unlike traditional banks that rely heavily on credit scores and lengthy financial statements, Square has direct access to your daily sales data. They can see in real time how much you're selling, how frequently, and what your average transaction size is. This isn't just about a high volume of sales. It's about consistency. Square wants to see a predictable revenue stream. Irregular or sporadic sales patterns, even if they sometimes peak, can be a red flag. They're looking for stability, which indicates a greater likelihood of consistent repayment. Think about it from Square's perspective. They're essentially lending against your future revenue. The more reliable and predictable that revenue, the lower the perceived risk. So, what does this mean for you? It means actively driving sales through your Square POS. Encourage customers to pay via Square, whether through card transactions, Square invoices, or even Square online store sales. The more transactions you process through their system, the more data Square has analyzed, and the stronger your eligibility profile becomes. Aim for consistent daily or weekly sales, rather than rely on a few large, infrequent transactions. Diversify your sales channels if possible, ensuring that a significant portion flows through Square. Next, we move to a critical, often overlooked aspect, your repayment history with Square. This might sound obvious, but it extends beyond just having a good credit score. If you've ever had a Square loan or a Square capital advance in the past, your repayment behavior on those specific products is paramount. Did you make your payments on time? Did you default? Were there any issues with the automatic deductions from your Square sales? A flawless repayment history with Square demonstrates financial responsibility and significantly boosts your chances of future eligibility. They're not just looking at your external credit. They're assessing your direct relationship with them as a borrower. Even if you haven't taken a Square loan before, your general financial health as observed through your Square account is considered. Are you frequently processing refunds or chargebacks? While some refunds are inevitable, a high volume could signal customer dissatisfaction, product quality issues, or even potential fraud. Chargebacks, in particular, are a major red flag for any lender. They indicate disputes with your customers and can lead to financial losses for both you and, indirectly, Square if they're involved in the payment processing. Minimizing refunds and chargebacks through excellent customer service and clear product descriptions is crucial. Let's talk about business tenure and activity. While Square doesn't explicitly state a minimum time requirement for using their services to be eligible for a loan, common sense dictates that the longer you've been actively processing payments through Square, the more data they have to assess your business's health and stability. A business that has consistently used Square for several months or even years presents a much clearer picture of its financial viability than a brand new account. This builds a robust data footprint, allowing Square's algorithms to confidently predict your future performance and repayment capacity. Beyond just the length of your relationship, the consistency of your activity is key. Are you using Square regularly, or is it an on and off affair? A business that processes payments daily or weekly through Square, even if the individual transaction amounts are small, demonstrates a consistent operational rhythm. This consistency is a powerful signal of stability and ongoing business activity. On the flip side, an account with long periods of inactivity followed by sporadic bursts of sales might be viewed with more caution. Your business industry and risk profile also play a role, albeit a more nuanced one. Certain industries inherently carry higher risks than others. For example, businesses with highly seasonal sales or those operating in volatile markets might face greater scrutiny. While Square doesn't publish a list of restricted industries for loans, their internal risk models will likely factor this in. If you operate in a high-risk sector, demonstrating even greater consistency in financial health through your Square account becomes even more critical. Similarly, businesses involved in activities that are legally questionable or prone to high rates of fraud will likely be excluded. It's also worth noting that the type of Square products you use can indirectly influence your eligibility. While using more Square products doesn't automatically grant you a loan, it deepens your integration with their ecosystem and provides them with a more comprehensive view of your business. For instance, if you're using Square Payroll, Square Invoices, and Square Online Store in addition to your POS, Square has a richer dataset to analyze your overall business operations, revenue streams, and expenses. This holistic view can contribute to a more favorable risk assessment, as it shows a more integrated and perhaps more stable business model. With that said, thanks for watching, and until next time.